Check out this chart. It's the S&P 500 going back to the 1960s, and it looks as though it's the best economy in history. But now look what happens when we map it against consumer confidence. It's the best stock market in history, but consumer confidence is at an all-time low. And if we zoom in a little bit closer, going back to about the 1990s, we can see that consumer confidence almost always predicts what's going to happen next in the stock market. In fact, you can see very clearly that back in the 1990s, when consumer confidence dropped, so too did the stock market. Then fast forward again to the financial crisis, consumer sentiment drops, so too does the stock market. And even in those early days of COVID, you can see that consumer sentiment and the value of the stock market were closely tied. Yet in 2025, we're seeing a divergence. For the first time in recent history, we are seeing the stock market continue to go up as people are feeling worse and worse about the economy. And what we could be seeing could in fact be the early days of one of the biggest financial resets in history, because the stock market, acting like it's the best market in history, while at the same time consumer sentiment is declaring that people are feeling worse about their finances than ever, well, both of those things can't really be true at the exact same time, can they? And not only that, I'm going to show you a little bit later on data that shows that your income has stopped growing at the same pace that it used to, that housing prices have gone up to levels that have never been seen before, that people on average are saving less, and in addition to that, inequality in the United States keeps getting worse and worse. Oh, and there's one big kicker to this whole thing, and it's one chart that's going to blow your mind. It's the share of wealth owned by the top 0.1% of Americans versus the US corporate tax rate. And the relationship between the two, well, even though I'm a believer in trickle-down economics, it makes a pretty solid case against it. Okay, so let's go back for a second to that first chart and look at that map of consumer confidence against the S&P 500. And it becomes really clear that what is happening right now doesn't happen very often. And when it does, when consumer confidence drops substantially, the stock market almost always follows. And there's good reason for this. I mean, just think about it. How well can the stock market do if all of a sudden everybody en masse all at once decides that the economy isn't good, things are getting scary, and they don't want to spend any more money? That's how the beginning of a market crash tends to happen. When all of a sudden on one day, everybody realizes that things aren't as good as they thought, and they change their habits immediately. And while consumer sentiment is an indicator of what's going on in people's minds, there's actually better data to support that this is actually becoming a real problem. If we go and we take a look at the S&P mapped against real personal incomes, it starts to paint an interesting story, an even more interesting story. As you can see, real incomes, which is incomes adjusted for inflation, going back to the 1960s, pretty much paints a story that the S&P 500 doesn't always outpace real incomes. And as you move further and further along in this graph, what you start to see is that the relationship, well, it started to drift, and it's drifted quite substantially. But when you start to look at what's happened over the last few years, what you clearly see is that this is getting way out of whack. Now, some people would suggest that what this means is that there's going to be an adjustment where the stock market and real incomes start to come back together. Now, it takes a very long time for real incomes to change, unless there is a substantial change in inflation. However, as we all know, a change in the stock market can happen pretty much overnight, which makes the likelihood of a massive crash, or at least a big one, significantly higher than it would be if the growth in the stock market and the growth in real incomes was about the same. So this becomes an indicator that the dynamics are way out of whack. The stock market probably shouldn't be where it is right now, but it is. What people are experiencing and the markets are clearly living in different realities. But the real question is why? And part of that has to do with the fact that there are several tech companies that are leading the S&P 500 and artificially making it worth more than it should be. Then in addition to that, there's another story, and it has to do with real incomes. You see, since the 1960s, people have pretty much come to rely on the fact that their incomes are going to increase at a rate of about 3% a year. This was always kind of the inflation adjustment that people expected every single year on their incomes, often known as a cost of living wage increase. But something changed, and it changed drastically after the 2008 financial crisis. Wages all of a sudden stopped growing at the same rate that they once did, going from a 30 to 40 year average of 3.1% down to an increase of only 2.3% per year. So that expected increase in wages that Americans would expect has not been there. And even though most people don't notice this, they feel it in their pocketbooks. And when you look at CPI, the cost of goods, compared to the relative incomes, the real personal incomes, you can see that there's clearly a difference. CPI has gone up substantially. This is inflation. But the incomes haven't followed. The wage inflation that would be normally expected, it just simply hasn't kept up. And this has led directly to the personal savings rates going down. So in other words, the cost of things are going up, the real personal incomes are staying the same or not going up as much, and subsequently, people have less money to save. And that becomes problematic in a lot of ways. One is because they lose the backup plan that they need if something were to go wrong, a job loss, a medical issue, but also because it simply makes it significantly harder for somebody to save, invest in something like the S&P 500, or in a lot of cases, even buy a home. And I'll show you some interesting stats on buying a home just a little bit later on. But before I show you that, it's important to note that this isn't a recent trend. Other than a significant spike during COVID, personal savings as a percentage of income has been on the decline since the 1980s, going from a high of 15% down to less than 5% of people's incomes. And there are several reasons for this, and they include one of the most popular things for people to buy, one of the most reliable things in modern history for people to own, which is real estate. But when you map real personal income against home prices, you can see that yet again, real personal income hasn't kept up. So if the ability to save has consistently been reduced, and all of a sudden people have less money to use for a down payment, or even less money to put aside, the barrier of entry to owning a home becomes drastically increased. And that starts to increase the amounts of inequality in the system. If prior to 2012 you had bought a home, you're probably in a pretty good spot. But every year that you've waited since, the barrier to entry by way of down payment has gone up and up and up. And by the way, you've got less money in your pocket in order to actually make the mortgage payments and be able to survive than you did before. And many people point to a specific graph, a specific stat when it comes to the real estate market. And that stat is the price to income ratio. This is the ratio that you get when you divide the average price of homes by the average income. And typically in the 1980s to the early 2000s, this number kind of floated between 4 and 5. So the average home was typically around 4 to 5 times the amount of the average income. In fact, back in the 80s and the 90s, realtors and lenders would use the rule factor 4 or factor 5 to determine how much somebody would qualify for when they bought a home. Now, keep that in mind, how much they would qualify for when they bought a home. And what they would do is they would simply say to a home buyer, well, what is your income? And if it was $50,000, they'd multiply it by 4 or multiply it by 5, depending on what the interest rates were at the time. And that would give a pretty good indicator of how much home somebody could buy. If it was a factor 4 market, it was about $200,000. And if it was a factor 5 market, it was about $250,000. But since the early 2000s, this factor, this reliable number that everybody seemed to think was a predictor of what home prices would do, it got way out of whack. In the early 2000s, it got up around 9, and of course, there was a financial crisis, and everybody blamed the fact that housing prices were way out of line with respect to household income. And while that was partially true, that wasn't necessarily the case. Then between about 2012 and 2015, this number got out of whack again. Well, there's a reason for that. And it's the reason why this average price to average income ratio, the price to income ratio that many economists, many YouTubers, actually it's not so many economists because most of them don't actually use this factor because they know that it's not reliable, but many YouTubers talk about this factor, and the reason why it's not a reliable factor actually has to do with that initial phrase that I mentioned, which was what they qualify for. Because the factor here isn't so much a measurement of house prices relative to income and whether or not they're out of line. This is actually a ratio that is largely dictated by interest rates. And the key thing with respect to this ratio is that this isn't so much a measure of housing affordability, as some people would like to say it is. It's a measure of where interest rates are. When interest rates get really, really low, the price to income ratio goes up significantly because the value of homes is actually less about the price and more about the payment. Values of homes are largely dictated by the interest rates and the amount that people qualify for. And the lower the interest rates go, the more people will qualify for, which is why the price to income ratio goes up. Now, if you look back to the 1970s, 1980s, think about where interest rates were, it's no surprise that price to income was significantly lower than it is today. So it wasn't the price to income ratio that dictated affordability and caused the 2008 financial crisis. It was actually the mortgage debt service ratios that got out of line. So in other words, the percentage of incomes that were going towards making mortgage payments. Now, as you can see, even though the price to income ratio is way higher in 2025 than it was in, let's say, 1987, the actual mortgage debt servicing rates are about the same. What caused the 2008 financial crisis was when this number got way out of whack. So while the markets and consumer sentiment seem to be out of alignment, the real estate market and real estate values and the mortgage debt servicing rates, well, they're actually very much in 2025 aligned with where they should be. So even though the market realities of the stock market are seeming to indicate that there's going to be a correction, the likelihood of this being an all-out financial crisis, well, we're probably not in danger territory there because the real estate market is very much where it should be, even though maybe it doesn't feel like it. But the important thing to note is the reason why it doesn't feel like it is not because housing prices are high, it's because wages combined with inflation are starting to make us feel like we have way less money. And it's that inflation combined with the lack of wage growth that's leading to this data. This is the Gini index. This is an index that's designed to measure the inequality in a country. And as you can see, since the 1980s, this number in the US has been going up and up and up. And ironically, you probably aren't going to believe what has caused this. It's that thing I was talking about that is going to make you rethink your beliefs with respect to trickle-down economics and whether corporate tax cuts and tax cuts for the wealthy are actually a good thing. And this is that chart. This is the chart that changes everything. This is the wealth ownership by the top 0.1% in the US. And as you can see, it hasn't been this high since the 1930s, since the Great Depression. And here's the thing about the Great Depression and why this is so worrisome. It's because the Great Depression wasn't just a financial issue. It wasn't just a stocks issue. It was a societal and political issue. And the real reason behind the Great Depression and why everything went bad so quickly was because of consumer sentiment. It was the moment that everybody realized that it was going to get bad, that it made everything worse and caused a spiral effect as people stopped spending money, stopped investing, stopped doing all the things that have brought the markets up and caused it to crash even faster. And at this moment, as the share of wealth is being transferred from pretty much everyone else to the top 0.1%, it's potentially brewing a complete disaster that could change the course of history forever. And the absolutely crazy part of all this, the really crazy part of it, is that there's one reason, and one reason only, that the share of net worth of the top 0.1% is going up so much. And it's this, it's corporate taxes. Because as you can see, the share of wealth owned by the top 0.1% is directly correlated to the corporate tax rate, which means every single time that the government and politicians make the argument that corporate taxes are too high, they need to be cut down, and when they are, there will be a trickle-down effect that makes everybody better off. Well, this graph goes to show that that's not the case. And when you have a stock market that is so out of whack with what is actually happening in the minds of people, combined with a level of wealth that is held by the elite that has not been matched since the early 1930s, as well as a political situation where there is continuing to be more and more divide, the next big reset could be one of the biggest resets in history. And while the data shows that things like the real estate market aren't necessarily at risk, it could be that defining moment where everyone decides at once that things are actually not as good as we thought they were. And by the way things are right now is totally unfair because the elite are winning at the expense of everyone else. Well, all the wealth in the world doesn't change the fact that 99.9% of people are not in that top 0.1%. And when there's a mass realization of everything that's happening, it could lead very quickly to not only an economic reset, but a political reset that alters the course of America forever. And as far as I'm concerned, that's probably the next real big financial crisis. Oh, and if you want to see what always happens before a financial crisis, make sure you check out this video right here.